You're sitting right in front of your screen right now. The numbers are all red. Every line of your portfolio is bleeding. You watch the total balance drop another $1,000 before you can even blink. Your palms are slick with sweat. It soaks into the edge of your desk. Your pulse thuds so hard in your ears you can barely hear anything else. Your index finger tenses, hovering half an inch above the sell button. You've run the math in your head a dozen times in the last 10 minutes. If you click now, you can still save a third of what you had. If you wait another day, it could all be gone. You've already watched half your gains evaporate. You don't want to lose the principal, too. The fear gnaws at the back of your throat. Every notification ping makes your jaw tighter. You're already mentally walking away, already planning to close the app and never open it again, just to make the pain stop. A little voice in your head is screaming, "Click it, click it, click it!" Your finger starts to lower. It's halfway to the button. But wait. Stop. Before you follow that impulse, let's step back. Let's look at the hard facts that almost no one is talking about right now. History does not lie. It doesn't hype. It doesn't panic. It just repeats. In patterns you can bet on. Patterns that have held steady through wars, recessions, pandemics, every crisis you can name. Let's put the hard numbers right in front of you, so you can see exactly where this crash fits in the bigger picture. Over the last 100 full years, the S&P 500 has experienced a correction of 10% or more every 1.2 years on average. That works out to one major drop every 14 months. Consistently, decade after decade, generation after generation. Most investors have no idea how common this actually is. The financial media only talks about corrections when they're happening, screaming about collapse and disaster to get clicks. They never remind you that these drops are normal. They're routine. They're baked into how the market works. You hear the panic 24/7, so your brain convinces you this time is different. This is the big one that will never recover. But let's look at what actually happened. Every single time. Every single correction in the last 100 years, without a single exception, recovered 100% of the losses. And it didn't stop there. Every single drop eventually turned into a new all-time high. Not most, not 90%. Every single one. I'm not here today to give you a generic pep talk. I'm not going to tell you to just hold on and hope for the best. That's useless advice that leaves you exposed when the market keeps dropping. I'm here to give you cold, hard data you can act on right now, starting with where we stand today. Pull up the Buffett indicator, the simplest, most reliable measure of overall market valuation we have. Right now, it sits at a screaming 223%. That's a level of extreme market froth we haven't seen in more than 2 decades. No one can deny the numbers. We were way overdue for this correction. That's not a secret. That's not a disaster waiting to happen. That's just the market correcting its own excess. But for anyone who knows how to read these signals correctly, this isn't the end of your investing journey. It's the start of the biggest generational wealth transfer you will ever see in your lifetime. Trillions of dollars are about to change hands. They're going to move out of the hands of emotional, impatient investors who panic sell at the worst possible moment. And they're going to land straight in the pockets of people who know what signals to look for, who prepared for this correction in advance. If you can learn to spot the 3 specific data signals I'm going to break down for you, this crash won't be your downfall. It will be your ticket to long-term financial freedom. Let's start with the first signal you need to track. It's not a fancy price chart covered in a dozen overlapping indicators. It's not a secret algorithm only hedge funds can access. It's the market's own emotion chart. We call it the VIX, the volatility index. Most new investors scroll right past it, assuming it's too technical to matter for their portfolio. But it's one of the most reliable tools we have for timing when to get into the market. Think of it simply. This is the market's collective fear gauge. In a normal, healthy bull market, The VIX usually hovers quietly between 15 and 20. That level tells you investors are calm. Prices are stable. Fear isn't driving anyone's buy or sell decisions. But pull up the data from right now, late March 2026, and you'll see a completely different picture. We've watched the VIX spike sharply, straight past 31. This is the well-documented territory of extreme fear. Why does that matter so much to you? When the VIX stays above 30 for consecutive days, it means retail investors have stopped thinking strategically. They've started reacting purely to emotion. They're not making decisions based on a company's actual fundamentals or future earnings. They're panic selling at any price just to stop the pain of watching their portfolio drop day after day. They'd rather lock in a huge loss than wait another 24 hours for more uncertainty. Now let's look at the historical data on this. Historically, if you buy into the broad S&P 500 index when the VIX is above 30, the probability of seeing a positive return 12 months later is over 85%. You don't want to be the one running for the exit when the sale starts. You want to be the one loading up on quality assets at a discount. That's the first signal. It tells you the market is scared. It tells you emotional selling has created widespread discounts. But here's the critical point most new investors miss. Extreme fear alone isn't enough to pull the trigger. Let me show you why. Extreme fear can persist in a falling market for weeks, even months. Every stock gets swept up in the sell-off, good and bad alike. If you jump in the second the VIX crosses 30, you could just as easily end up holding a bag of overhyped speculative junk that has no real fundamentals to support it. Those companies don't just drop during a correction, they collapse. They never recover their old highs, even when the rest of the market bounces back to new records. You don't get a discount on a stock that was worth zero even at the top of the bull market. You just get a zero for half price. That's still a loss. That's the trap that catches greedy new investors who only see the VIX spike and don't dig any deeper. So we need more than just widespread fear. We need a concrete second signal to separate the genuine bargains from the dead weight. We need to confirm that we're buying undervalued quality assets, not just catching falling junk that was already worthless. That second concrete signal we need is called the valuation reset. Let's start with the numbers we already know. Right now, the Buffett indicator, the simple ratio of total U.S. stock market capitalization to GDP, is sitting at a staggering 223%. By any historical standard, that's incredibly expensive. We were way overdue for this correction. And that's exactly what we're getting right now. But here's the turning point no financial pundit is talking about. During every broad market crash, we get what's called a mean reversion. What does that mean for you? It means solid, high-quality companies, the titans of tech and industry that grow their earnings year after year in and year out get dragged down along with all the junk speculative stocks that were overhyped during the last bull run. The entire market gets sold off indiscriminately, regardless of each company's individual fundamentals. No distinction is made between the next generation of profitable giants and the pump-and-dump scams that were never going to last. This indiscriminate sell-off is exactly what creates the bargain we're looking for. Let's pull hard data from the 2022 market crash to prove this. Back in 2022, when the whole market tanked, investors who bought shares of top profitable giants when their price-to-earnings ratios hit 1-0 year lows saw their capital double, and in some cases triple, over the following 3 years. The data doesn't lie. Companies with strong, consistent cash flow and zero long-term debt don't turn into bad companies just because their stock price drops 30% in a broad sell-off. They don't suddenly stop selling products or serving customers. They just become mispriced assets worth far more than the market is pricing them at right now. Now we have two solid signals to confirm we're looking at a genuine buying opportunity. Extreme fear has created the discount, and valuation checks confirm we're buying quality, not junk. But this brings us to the final, most critical mistake that derails even prepared investors: trying to catch the falling knife. Most ordinary investors fail to profit from crashes because they get greedy. They want to buy at the absolute bottom of the market, to lock in the lowest possible price and maximize their gains when the recovery starts. But here's a hard reality check that even the most experienced investors know by heart. Even the best hedge fund managers in the world can't pick the exact bottom consistently. No one can call the bottom with 100% accuracy. Trying to do it isn't investing, it's just straight gambling. You're guessing, and the odds aren't in your favor. So what do we do instead? We build a strategy that works regardless of when the bottom hits, using hard data from a full century of market crashes. That's our third and final signal, the recovery cycle, paired with a simple mechanical laddered entry strategy that takes all emotion out of the process. The data proves it works every single time. Let me break down how it works. First, we use historical data to set expectations. A standard 10 to 20% correction takes an average of 8 months to fully recover. A full bear market drop of over 20% can take up to 2 years to hit bottom and start a new sustained rally. Remember the oldest, most proven saying in all of stock market history. The stock market is nothing more than a device for transferring money from the hands of the impatient to the pockets of the patient. That's it. No more, no less. When everyone else is panicking and locking in their losses to sell at the bottom, the patient investor who held on to dry cash buys those same shares from them at a massive discount. There's no trick, no insider secret, just a consistent transfer of wealth that plays out exactly the same way after every single crash in recorded history. Right now, you're probably sitting in front of your screen feeling that old panic tug at your finger hovering over that sell button. You're telling yourself you'll just get back in when the coast is clear, when things stop feeling scary. But let me hit you with one critical fact that almost no new investors know. The best 30 trading days in the entire 100-year history of the stock market almost always occurred immediately after the worst crashes. Those few incredible up days are what make up the entire long-term gain of the market. If you're sitting on the sidelines in cash, waiting for the right time to get back in, you will almost certainly miss those few days. And the data doesn't lie about what that does to your returns. Your long-term returns could be cut in half. That's not a tiny, insignificant difference. That's the difference between retiring early with the portfolio you've dreamed of and working 5 more years just to make up the gap you created by panicking. That's the cost of being impatient. That's how the wealth transfer happens. We are in a period of massive, unprecedented volatility here in 2026. Every headline screams doom. Every social media feed is full of people declaring the end of investing as we know it. But let me reframe that volatility for you in one simple sentence. Volatility is just another word for opportunity. This crash isn't going to destroy wealth for everyone. It's going to transfer trillions of dollars from the hands of the emotional, reactive crowd to the pockets of those who show up prepared. Don't let your own fear of loss rob you of the financial future you've worked years to build. You don't have to guess your way through this. I've already laid out the 3 clear, data-backed signals you need to spot the right time to buy. All you have to do is check them off as you see them in the current market. If you want to navigate this crash with a clear, step-by-step plan that you can follow starting today, click the link in the description below to download my Market Bottom Checklist for free. It lays all 3 of these signals out in simple, plain language, with clear checkboxes you can mark as you track the market each week. You'll never have to wonder if it's time to act, or if you're missing the right entry point. Everything is spelled out for you. It takes 5 minutes to download, and it will keep you from making the costly emotional mistakes that wipe out portfolios in crashes like this. Right now, you have a choice. You can be the prey that gets shaken out and robbed of your gains by your own panic. Or you can be the hunter who walks in and picks up all the cheap, high-quality assets left behind by other people's fear. That choice is entirely yours. Hit that subscribe button right now and turn on post notifications so you don't miss the next update as this crash unfolds and the recovery takes shape. Let's grow your wealth together. while the rest of the world is still standing on the sidelines panicking. I'll see you in the next one.